The slices of the conversations we've been having since morning. It's a very important day. We've been getting you very special voices, and one of them is now joining us live. Gautam Duggad of Motilal Oswal. He's the head of research there. Gautam, good afternoon. Thank you so much for your time. You just come back from UK, and that ahead of the exit polls, ahead of the election results. I'm sure many of your conversations would be around this as well. Now, though, I caveated it's a small near-term factor for institutional investors, but nevertheless, the curiosity must be high. When will FIIs come back? Because they've been voting with their feet right now for Indian markets, right? Abandoning us for months.
Ajay, yeah, thanks for having me. So I think one needs to look at it in a slightly holistic view. It doesn't matter who comes back, who doesn't come back. Just remember, in India, in the last 3 years put together, CY22, CY23, and YTD CY24, the total FII flows are zero. Right? They sold $17 billion in CY22. They bought around $21 billion in CY23. And the first 5 months, they sold again for 4.5. So net, it works out to zero. On the contrary, the domestics CY22, 23, 24 put together bought $72 billion. So the direction of the market in the last few years is decided more by the domestic flows. I'm not saying FI flows don't matter, of course they do matter. But it's not as if that you have to track them a very minute and a granular basis, because that sort of an influence that they used to have on the direction of the market is no longer there. Plus, obviously, given where India's valuations relative to other emerging markets stack at, I'm sure some of those flows have rotated out of India towards China and some of the other emerging marketplaces. But fact remains that India has been sort of, as I keep telling a lot of my team members, in a mini Goldilocks situation. You had 8% GDP growth last year, 8.2. We just finished FY24 earnings season with a 25% earnings growth. Our twin deficits, fiscal and current account deficits, are well within the tolerance band. Inflation is at around 5%. Currency is stable. Crude is 80, 82. So a lot of the operating macro fundamentals are in a very good shape for India. On top of that, if tomorrow exit polls turn out true and actual results is in line with the exit polls, then you also have 5 more years of policy stability and continuity, which augurs very well from a broader macro point of view for India as a destination. So we are, I think, best placed in the Committee of Nations as far as the capital markets are concerned. And I think the expected earnings growth should keep this momentum intact. So at some point of time, you will see FII flows coming in.
I think one of the impediments for them has been the fact that the valuations are a bit punchy, 1.5 standard deviation higher than the average. But nonetheless, I wanted to get a bit more micro and discuss some of your top ideas. And I see within large cap financials, you have a tilt toward ICICI Bank and SBI. Why not HDFC, despite the kind of valuations that we are seeing, or even Kotak Axis, etc.? Why the preference towards ICICI and SBI?
So last 2.5 years, we've been significantly overweight on PSU banks in our model portfolio. In fact, if you look at our model portfolio, the highest overweight across sectors stands at PSU bank. And that has worked very well for us. Now, if today also you compare where PSU banks stand on valuations versus what they've already delivered in terms of earnings, the valuations are still very, very cheap at about 1 to 1.25 price to book. For companies which have delivered 17 to 20% ROEs, right, where asset quality is extremely strong, credit growth is in the range of 12 to 14%. So while we like private banks, we like PSU banks more. And within private banks, our stance has been very clear for now more than 2 years that ICICI Bank is the best position in terms of the combination of credit growth, operating profit growth, as well as balance sheet quality. Yes, I do agree that HDFC Bank is also looking quite reasonably priced for last more than a year now, but relatively within the overall spectrum of the financials, we are significantly overweight on PSU banks, then NBFCs, then NBFCs non-lending, and we are running an underweight stance on private banks, largely owing to our significant underweight position on HDFC Bank, and I think we'll continue with this stance for some time.
Now, all of us in the market are always trying to read more and more into the commentary of the management, and in this case, the management is Mr. Modi. And from Kanyakumari, he has just written a kind of a guidance note saying that the next 100-day agenda would entail a lot of work on railways, a lot of other stuff as well. Kind of hints that the direction of the reforms. Have you been analyzing this, and what are your thoughts on some of the manufacturing / railway kind of themes, which have done pretty decent as well, but does it have more juice left?
So Ajay, all of us are saying that policy continuity is good for the market, stability is good for the market. So I think what they've been prioritizing in the last 10 years is something I expect them to prioritize for the next 5 years as well. Of course, there could be some tweaks here and there. There could be some acceleration in, say, let's say, for example, they might have built 2 crore, I don't have the exact number, they might have built 2 crore houses. They might build 3 crore next 5 years. Tap water. Similarly, in railways, Vande Bharat, manufacturing, defense, capital goods, real estate. So there is no reason per se to sort of change the portfolio construction just because this event is happening around us. Do understand that this event is a continuity, right? It's the stability that we all are so obsessed with, which is the market got nervous in early May when there was some bit of anxiety around the voting percentage turnout after first 2 phases. You saw a dip in the market and all of that. So market inherently obviously hates uncertainty. So to that extent, whatever policy framework, whatever momentum we've been seeing on the policy, that is expected to continue, and that is why we are not changing our stance in our model portfolio, which is very clearly biased towards domestic cyclicals, and within that towards industrials, real estate, PSU banks, and automobiles.
Continuity, yes.
Of course, I forgot to mention, Ajay, railway and power, of course, remain mega themes, and they can continue to last another decade or so, and still we might feel that the penetration is still very low.
Yeah, I think that's the kind of re-rating that we have seen and the kind of demand which is there with respect to power and railways and infrastructure. Maybe these are going to be the decadal themes. But you're talking about policy continuity, Gautam, but let me flip this question then. How do you think Modi 3.0 can be different from Modi 2.0? And in terms of the worries that the market has around budget, around capital gains tax, how big an impediment could this be with the market mood right now?
I think so far as capital gains tax is concerned, because that's an element which has been discussed ad infinitum for the last 3 months. And I think in between, the finance minister herself came and clarified that this is not on the agenda. So I don't know whether the government will even attempt to do that. As far as the rest of the things are concerned, I think the first budget will be very important because it will set the tone for the priorities on the policy front for this government for the next 5 years. Now, we all know that in the last 5 years, the capex budget of the government, rather last 6 years, the capex budget of the government has gone up from 2.5 trillion to almost 11 trillion. And at some point of time, it will also result in acceleration in private capex. It will crowd in the private capex too. So that is a very, very important thing to focus upon in my view. Second, other priorities, very tough to say because they have not articulated it at anywhere or any other forum. This is something which Prime Minister has been mentioning in his speeches and in his campaign, that he has a very heavy agenda for the first 100 days of his third stint. But what exactly does it entail? We will find out in the fullness of time. As I said, the focus, if last 10 years track record is anything to go by, then I think you would see more acceleration in some of the themes, some of the agenda items which already worked, which is what I just enlisted to Ajay in the last question.
One thing I wanted to talk to you about, Gautam, was the rural stress. And we've been seeing almost 7-8 quarters of barely any volume growth in some of the rural names. But this quarter, not only the results were slightly on the better side, but the commentary guidance for coming quarters clearly stood out in all 4 large companies. And even the government has come under a bit of a criticism that perhaps some steps need to be done towards removing or reducing rural stress. In this government's tenure, if it comes in the same direction, do you see rural side of the economy also being addressed, and hence some rural names should be looked at given the valuations are low? Gautam?
Okay, I think we'll try and reconnect that line, but I think that's an important point which we've been hearing in a lot of these management commentaries as well, that rural is showing signs of recovery, and the experts have been talking about at least looking at it incrementally positive, but let's see whether they're able to deliver that or not. We'll try and reconnect that line because we do have, other guests also lined up later on the show. In fact, why don't we do one thing? We'll take a short break, come back and then take the market discussion forward.